As missiles soar across the skies of the Middle East, the world is not only anxious about war, but also holds its breath over oil prices. The conflict between Israel and Iran, seemingly a familiar refrain, has erupted more violently than ever, especially with the U.S. no longer standing on the sidelines. But behind the gunfire lies another front no less heated: the global market. Is the world about to face a new economic shock? Amid persistent inflation, supply chains still unrecovered from the pandemic, and a prolonged war in Ukraine, the U.S. involvement in the Israel-Iran confrontation is no longer just a political issue. It's a spark for a global economic earthquake. The Israel-Iran conflict broke out on June 13th, beginning with an unprecedented series of Israeli airstrikes deep into Iranian territory. Tel Aviv stated that the reason behind these actions was to prevent a long-standing enemy from developing nuclear weapons, which they consider an existential threat to Israel's national security. Within less than 24 hours after the first strike, Israel continued attacking dozens of strategic targets across Iran. One notable target confirmed was Iran's domestic security headquarters in Tehran, a highly symbolic and tactical move showing the boldness of Israel's calculations. Tehran's response was swift and fierce. Iran launched a barrage of ballistic missiles and kamikaze drones into Israeli territory, stressing that its nuclear program is entirely civilian and peaceful in nature. A fierce tit-for-tat exchange of airstrikes continued for days, leading to rapidly mounting humanitarian consequences. According to the Middle East Red Cross, over 600 people were killed and nearly 5,000 injured within just the first 4 days of the conflict. More significantly, on June 21st, U.S. time, President Donald Trump appeared before the international media, declaring, "The United States, along with its allies, will act to protect the security of the Middle East." This message was immediately followed by action. The Pentagon deployed air forces, aircraft carriers, and special operations forces straight to the Gulf. Through the social media platform Truth Social, Trump confirmed that the U.S. had conducted highly successful airstrikes on Iran's nuclear facilities. The Israel-Iran war quickly plunged the entire Middle East into high alert, with the risk of escalation into a full-blown regional war becoming increasingly evident. With the United States, one of the world's leading military powers, officially entering the conflict, it has now surpassed the regional scope and evolved into a potential multilateral war with global implications. This event also marks a dangerous turning point. It is no longer a bilateral conflict between Israel and Iran, but a war that could entangle entire alliance systems and fracture the global geopolitical and financial order. So how much will the global economy have to pay for this ever-expanding war? First, there has been a strong chain reaction across global markets. Oil prices have surged, while investors are pulling money out of stocks in favor of safer assets like gold and government bonds. Starting with oil prices. As analyzed in our previous episode, about 1/3 of the world's seaborne oil passes daily through a narrow strait, Hormuz, right next to Iran. And in a war with Iran at its center, Hormuz becomes a vital choke point. Experts from the International Energy Institute warn, if Hormuz is blocked for just 1 week, global crude oil prices could jump by more than 40%. That means just a minor move from Iran, such as laying sea mines or threatening to fire on oil tankers, could send global markets into disarray. Once the US is involved, shipping routes will face severe disruptions. Shipments from the Middle East to Asia will be forced to take longer detours. Rising oil prices, rising transportation costs, rising global commodity prices. And the first to feel the impact might be consumers in Los Angeles, not Tel Aviv. Right after the US airstrikes, Brent crude surged from $91.8 to $124 per barrel, the sharpest increase since the Iraq crisis in 2003. US WTI oil exceeded $120 per barrel. As a result, gasoline prices in the US rose an average of 0.85 per gallon. Asian countries such as Japan, South Korea, and India, which import over 80% of their energy, are suffering from input cost shocks. The Global Consumer Price Index, CPI, could rise by 1.2 percentage points, according to IMF forecast. Next comes the stock market and global financial turbulence. On June 23, according to CNBC, the Dow Jones rose by 374.96 points to close at 42,581.78. The S&P 500 gained 0.96% to reach 6,025.17, while the Nasdaq increased by 0.94% and closed at 19,630.97. U.S. bond markets also saw major fluctuations. The 10-year Treasury yield jumped to 4.9% due to concerns over war expenses and budget deficits, while the U.S. dollar strengthened in the short term. Medium-term risks rose as the U.S. issued more public debt. The global supply chain has also been disrupted. Shipping giants like Maersk and MSC announced route changes to avoid the Persian Gulf. Container shipping costs from the Middle East to Europe have doubled. Air travel is also in chaos. Due to safety concerns, multiple countries, including Israel, Iran, Iraq, and Jordan, have closed their airspace. Major airlines such as El Al, Air France, Ryanair, and Wizz have had to cancel or reroute flights. Flight radar data shows that Middle Eastern airspace is virtually paralyzed, with traffic rerouted through Saudi Arabia and Egypt. The escalating conflict has severely impacted global aviation stocks. Political analyst Elijah Magnier in Brussels has warned that the escalation of the Israel-Iran conflict with direct U.S. involvement could lead to the closure of the Strait of Hormuz, causing severe global economic disruption.
Because Israel received the money from the United States, it has all the support from the military and the economy, and the United States is giving Israel enough weapons to continue the war. If the United States stop that, then Israel cannot wage war. It is indeed the most dangerous time for the Middle East, because in case of the participation of the United States directly, because it is participating indirectly, then Iran will close the Strait of Hormuz. Therefore, the world economy will be disturbed and will suffer delay. Everything will stop and people will panic. And then this is going to create a worldwide crisis, economic crisis.
In the near future, the global economic outlook is predicted to become increasingly bleak. Tensions between Israel and Iran are escalating amid global markets already affected by President Donald Trump's unpredictable tariff policies. The threat of high tariffs on imports into the U.S. has disrupted global trade, shaken investor confidence, increased costs for both consumers and businesses, and slowed global growth. If the Israel-Iran tension drags on, these pressures will worsen. Additionally, any disruption at major gas fields like Israel's Tamar or LNG exports from the Gulf will further strain energy markets in Europe and Asia. If the conflict spreads, maritime transportation and the tourism industry could be paralyzed. Since late 2023, Houthi forces have repeatedly attacked commercial ships in the Red Sea, a vital trade route, causing shipping costs to many major shipping companies have had to reroute around the Cape of Good Hope, extending routes and expenses. Though some research institutions have recently downplayed the risk of global recession, if Trump's unstable tariff policies combined with a prolonged Middle Eastern conflict, the risk of global economic recession could rise alarmingly. Thus, economies must prepare flexible response scenarios, from financial market regulation to securing energy and trade flows. In the U.S., within less than a week of declaring war, Congress approved an emergency defense spending package worth $96 billion. However, if the war drags on for more than 6 months, military spending could exceed $450 billion, about 2%. of GDP, a heavy burden on an already deeply indebted federal budget. As a result, the debt-to-GDP ratio could exceed 130%, a level unseen since World War II. This figure not only concerns Wall Street, but also raises the question, how will the US fund the war? It's not just the budget being stretched. American consumer confidence is also rapidly declining. The Consumer Confidence Index has dropped from 110 to 96, indicating public concern over prices, jobs, and future uncertainty. Inflation, which had just been brought under control last year, is showing signs of returning, pushing up living costs across fuel, food, and transport. And if the US becomes deeply involved in the conflict, rising war costs will place immense pressure on the federal budget. Given that the US already has over $34 trillion in public debt, war will require hundreds of billions more in borrowing. But with high interest rates to curb inflation, borrowing becomes extremely expensive. The likely consequences include U.S. government bonds losing appeal due to debt ceiling concerns, international financial institutions losing confidence in the U.S. as a safe haven, potential downgrade of the U.S. credit rating, as S&P did in 2011 after a debt ceiling crisis. The U.S. dollar, in particular, becomes a double-edged sword. In the short term, the dollar strengthens due to safe haven demand. But if the conflict drags on, the U.S. is forced to print more money, raising fears of oversupply and ballooning debt. The dollar loses relative strength, dragging emerging economies into currency depreciation and foreign debt spirals. As capital flows out of developing countries, regional financial crises intensify. Consequently, Europe may once again face the risk of an energy-starved winter, as oil and gas supplies from the Middle East are disrupted. This puts the European Central Bank in a dilemma: keep interest rates high to fight inflation or cut rates to support growth. Meanwhile, in Asia, major economies like China, South Korea, and India are rapidly boosting their strategic oil reserves, spiking global oil demand and pushing prices even higher. Simultaneously, many manufacturing firms must reconsider their spending and expansion plans due to rising input costs. As for Israel and Iran, surging military expenditures and the heavy damage caused by the conflict will impact both economies. Israel is in the midst of an expensive war, while Iran continues to suffer from years of economic sanctions. Israeli economist Yaakov Sheinin estimates that if the conflict spreads, the cost could exceed $120 billion, equivalent to 20% of the country's GDP. In Iran, a crisis-ridden economy already under sanctions due to its nuclear program. Oil exports are restricted, the rial is weakening, and inflation remains high at around 40%. Combined with direct impacts on infrastructure and consumption, the conflict has severely damaged regional market confidence. Investors fear prolonged war will lead to interest rate shocks, exchange rate volatility, and capital flight from risky assets. Throughout the above analysis, one reality becomes clear. The Israel-Iran conflict with direct U.S. involvement has triggered a wave of global economic shock. This conflict reveals a systemic truth. In the age of globalization, every military action sends aftershocks far beyond the battlefield. We are living in an era where the boundaries between war and economy are increasingly blurred. Today's war is not only fought in trenches, but also in trading floors, interest rate charts, oil reserves, and defense budgets. So where is the world headed? If the conflict continues or escalates into a broader multilateral war, the economic consequences may not stop at oil prices or inflation. It could erode market confidence, stall the global recovery cycle, and create deep, lasting cracks in an already fragile post-COVID economic order. The global economy is like a crystal vase, already cracked, and the Israel-Iran war with U.S. involvement is the next powerful blow. Without swift, coordinated policy responses and risk controls, what we're witnessing today may just be the beginning of a much longer period of instability. The war's end is unknown, but the economy, if not promptly protected, may be the first and clearest casualty of this increasingly unpredictable conflict.
Since the beginning of 2025, when geopolitical tensions in the Middle East escalated, the global financial market has had remarkable reactions, especially the U.S. defense stocks. According to statistics from Bloomberg and Reuters, amidst the fire and smoke of war, Lockheed Martin shares quietly increased by more than 25%. Northrop Grumman shares increased by about 31%. And Raytheon Technology shares recorded an increase of nearly 40% in the first half of the year alone. This is not a temporary phenomenon. Every time a conflict breaks out, the stock value of these corporations increases, followed by a series of defense contracts worth tens, even hundreds of billions of dollars. In that context, the US Congress continues to maintain a huge military spending level, $886 billion for the year 2025, equivalent to more than 3.3% of GDP. A significant part of this flows to private corporations, the main defense contractors of the United States. It is worth mentioning that while the defense budget is increasing, spending on health, education, or social housing is being cut in many states. People bear taxes, struggle with inflation, and reduce welfare, while the defense market records profit beyond expectations. So the question is not how much damage does war cause, but each year, how does the US defense industry really earn from the war? And who are the people paying for this game? Welcome back to Economy Roast. In today's video, join me as we unpack the numbers behind the gunfire and explain why war can be a nightmare for the world, but a golden harvest for American military corporations.
When it comes to military power, the United States of America is always the first name that comes to mind for many people. It is no coincidence because this country possesses a giant war machine, far surpassing all competitors in the world. According to the Stockholm International Peace Research Institute, SIPRI, the US accounts for a staggering proportion, more than 1/3 of total global defense spending. To maintain this superpower status, the United States is constantly pouring huge amounts of money into the defense sector. The defense budget for 2025 alone has reached an unprecedented record, $886 billion. Imagine how big this number is. It is not only a resource for national defense, but also an extremely powerful economic engine that nurtures a separate industry. And this is where we need to introduce a core concept to better understand this issue: the military-industrial political complex. This is not just an academic term, but a reality that shapes American policy and the economy. Essentially, it describes the close symbiotic relationship between lawmakers, the national military, and the arms manufacturing corporations. The arms manufacturing corporations provide technology and jobs. The military ensures the procurement and use, and politicians, through budgets and policies, maintain this cycle. This connection is so strong that it can create common interests, sometimes beyond the purely national security interests. Even former US President and five-star World War II General Dwight D. Eisenhower once warned about a quiet but persistent power. In the councils of government, we must guard against the acquisition of unwarranted influence, whether sought or unsought, by the military-industrial complex. With what is happening is what Eisenhower feared gradually becoming a reality. Some analysts believe that US defense corporations not only produce weapons, but are also big guys in the financial market, having a direct influence on foreign policy and security. It is no coincidence that every time geopolitical tensions flare up, defense industry stocks skyrocket. The names dominating the global arms market are none other than Lockheed Martin, RTX, Raytheon Technologies, Boeing, General Dynamics, and Northrop Grumman. Since the attacks of September 11, 2001, the Pentagon has spent at least $4 billion on these five companies, a number that is enough to imagine the level of dependence and the scale of profits they earn. Let's take a look at the specific numbers and clear evidence for this golden opportunity. Lockheed Martin's corporation is not only famous for the F-35 stealth fighter or advanced missiles, satellites, and radars. In 2024, Lockheed Martin achieved revenue of $71,043 million, marking an increase of 5.14% compared to 2023. Financial reports for the first quarter of 2025 show that their revenue continued to grow by 4%, reaching $18 billion. From June 2024 to June 2025, LMT stock fluctuated but remained high, ranging from $467.1 to $460.445. This demonstrates their remarkable resilience in a volatile market. For example, a HIMARS system manufactured by Lockheed costs about $10 million. And Poland alone has ordered $10 billion worth of it by 2023. Huge orders that go straight to Lockheed Martin. Raytheon Technologies RTX, known for missile systems like the Tomahawk. Each one costs about $2 million. In 2024, RTX will record an impressive revenue of $80.74 billion, up 17.15% from 2023. And what's really remarkable is that from June 2024 to June 2025, RTX's stock has increased by an impressive 41%, from $100.39 to $141.55. For 2025, RTX is even more optimistic, forecasting adjusted sales of $83 billion to $84 billion, along with expectations for continued strong earnings growth. This is a growth that clearly shows the direct link between conflict and profits. Northrop Grumman specializes in aerospace and defense technology, known for its next-generation stealth bomber projects. In 2024, Northrop Grumman will achieve revenue of $41.033 billion, up 4.44% from 2023. Their NOC stock is also not out of the growth trend, rising from $435.95 to $490.025 from June 2024 to June 25, an increase of 12.4%. Although Q1 2025 recorded a slight decrease in revenue to $9.5 billion due to specific factors, with a record backlog of $92.8 billion, their long-term prospects remain extremely bright. Boeing Defense and General Dynamics, the other two big guys, also hold major contracts with the Pentagon. In 2024, Boeing's defense division, Boeing Defense, Space and Security, achieved revenue of $23.92 billion. In early 2025, this segment recorded $6.3 billion in revenue for Q1. Meanwhile, General Dynamics achieved revenue of $47.7 billion in 2024 and began 2025 with Q1 revenue of $12.2 billion, marking an increase of 13.9% year over year. According to Morgan Stanley, General Dynamics shares rose 14% from June 2023 to April 2025. In total, the United States exported a record $318.7 billion worth of weapons in 2024, an increase of 29% from 2023. This figure far exceeded all previous predictions and demonstrated how the war in Ukraine has significantly boosted global demand for weapons. For 2025, although the final figures are not yet available, with a record United States defense budget of $886 billion and geopolitical tensions continuing to escalate, experts predict that global arms exports, and especially those of the United States, will remain extremely high, possibly even exceeding the $350 billion mark. Clearly, revenue from wars increases every year. Since the outbreak of the Ukraine conflict and the increase in tensions in the Middle East, the demand for weapons, from anti-aircraft missiles to fighter jets, has been pushed to record highs. When the war broke out, the stock prices of defense corporations also exploded, reflecting the market's expectations for lucrative contracts. So where do these numbers come from? The Pentagon is their biggest and most loyal customer. These corporations cannot survive, cannot thrive without government contracts worth billions of dollars every year. This is not just a normal buying and selling relationship, it is the lifeblood of an entire industry. Every year, when Congress approves the defense budget, hundreds of billions of dollars are transferred to private arms corporations in the name of military procurement contracts. Here's how it works. Congress approves defense spending. For example, in 2025, the figure is $886 billion, setting a new record. The Department of Defense allocates the budget by category, from research and development to production and deployment, Arms corporations such as Lockheed Martin, RTX, General Dynamics receive orders, deploy production, and report quarterly profits. To better visualize the scale of these contracts, let's look at some concrete examples, the numbers of which can make us think. Take the Tomahawk cruise missile. As we know, each missile costs about $2 million to produce. With conflicts taking place around the world, the demand for this type of precision strike weapon is constant. Each time a country orders hundreds, even thousands of them, the amount of money that flows to corporations is up to billions of dollars for just one type of product. Not only weapons, but military infrastructure is also a huge source of profit. Building a new military base can cost 500 million US dollars or more. These projects include not only construction, but also technology systems, security, and long-term maintenance, all of which are lucrative contracts for private companies. And the pinnacle of defense contracts is probably the construction of an aircraft carrier. The cost of building a modern supercarrier like the Gerald R. Ford class can be as high as $13 to $14 billion. That is 13 to 14,000 million US dollars. These are projects that span decades, ensuring a stable and long-term source of revenue for the shipbuilders and their suppliers. These numbers are not just individual orders, they represent a huge supply chain, an economic system built to meet and sustain military needs. It is these huge and continuous contracts that have turned defense companies into powerful financial forces, with a steady stream of income from government spending policies. As we see, U.S. defense corporations raking in hundreds of billions of dollars a year from war, the inevitable next question is, who is paying for this game and who is being left behind? Just look at the federal budget balance sheet. In 2025, the U.S. defense budget hit $886 billion. That's right, nearly $900 billion, more than the entire GDP of several developing nations combined. Just $1.5 billion for the entire country's welfare programs. That's less than $2 billion for millions in need. The question here is not, America is short of money. It's what is the US government prioritizing spending on? Education is cut by 8% in 2024 to 2025. Millions of people lose access to Medicaid, the health insurance system for low-income people. Meanwhile, the defense budget continues to rise steadily year after year, despite inflation and public debt. A concrete example, in Detroit, once the manufacturing heart of the United States, many public schools do not have enough computers for students. A classroom without glass, the cold winter wind cuts through the skin, students have to wrap themselves in blankets to study. Meanwhile, the US spends billions of dollars to build 3 new military bases in Saudi Arabia, tens of thousands of kilometers away, a place American students will never set foot. This is no longer a budget issue, it is a public morality issue, a reflection of national priorities. Fiscal policy is a statement of values. If a country is willing to spend nearly $1 trillion on war, but hesitates to spend a single penny on schools, hospitals, housing, etc., then the problem is no longer money, it is direction. So what are the American people paying taxes for? A shrinking welfare system, rising inflation, overstretched healthcare, while arms stockpiles continue to rise steadily with each new conflict. In response to this situation, U.S. Senator from Vermont Bernie Sanders voiced his opinion in an op-ed published on his official website titled, "Why I Voted Against the Defense Budget," December 2024. Sanders criticized the enormous U.S. military spending while everyday Americans continue to struggle. He stated, "Today in the United States, 60% of people live paycheck to paycheck. But while so many Americans are struggling to survive, the U.S. is spending a record amount on the military. We are now spending more than the next 9 countries combined." War, in its economic nature, is a business, and like any business, it seeks revenue, growth, and inputs. But unlike conventional industries, the raw materials of the war economy are smoke, fear, and human lives. Every time a $2 million missile is launched, it burns not just fuel, but public money taken directly from taxpayers' pockets. Lockheed Martin, Raytheon, Boeing may report quarterly profits, but what about the people? They report losses in welfare, healthcare, education, and trust in government. So what do you think about everything we've just explored? Leave a comment and don't forget to subscribe to the channel for more economic analysis like this. Thanks for watching and see you in the next video.
$175 billion. That's the total amount approved by the US Congress to support Ukraine since the war began in 2022, according to figures from the Council on Foreign Relations, CFR, and the Committee for Responsible Federal Budget, CRFB. This is not just a dry financial number, but a powerful strategic statement reflecting the unprecedented depth of US involvement in a modern European conflict. A huge number, larger than the GDP of many developing countries, far exceeding the US federal education budget for many years combined. A country where every expenditure on the poor, on health, on education is a never-ending debate, can easily approve hundreds of billions of dollars for a war half around the world. So in the end, what benefits do the United States and the majority of American people actually receive? Or is it only a small group that benefits? Welcome back to Economy Roads. Let's dive into the analysis of the topics mentioned above in today's video. Are you ready? Let's get started.
According to a report from the Committee for a Responsible Federal Budget, CRFB, as of early 2025, the U.S. Congress has officially approved a total of $175 billion in emergency aid to Ukraine. This amount is not just an abstract number, it is clearly divided and has a purpose. About $117 billion has been allocated for defense systems, including weapons, ammunition, air defense systems, unmanned aerial vehicles, UAVs, and training and technical support programs of that amount. Approximately $66 to $68 billion has been disbursed directly by the Pentagon through contracts with major U.S. defense contractors such as Lockheed Martin, Raytheon, General Dynamics, and others. This means U.S. tax money has been converted into contracts to produce strategic weapons, HIMARS, Javelin, Patriot, F-16, etc., to support Ukraine. Additionally, as of March 14, 2025, 68% of the $182.8 billion in aid was security assistance. According to USA Facts, nearly $124 billion of the total was earmarked for military purposes. In fiscal year 2023, the Pentagon disbursed $12.1 billion through the Ukraine Security Assistance Initiative, USAI, a key component of military aid coordinated by the U.S. Department of Defense. USA Facts data also shows that $83 billion of that amount has actually been spent, including contracts, equipment deliveries, support services, and personnel not merely allocated on paper. So where did the $170 billion US poured into Ukraine actually go? The answer may surprise many. Most of it did not go directly to Kyiv. Instead, most of it stayed in the US. Nearly 70% of the $175 billion in US aid to Ukraine since 2022 was spent in the US, or on US forces, according to a study by the American Enterprise Institute published in May 2024. Specifically, most of the military budget was used to sign contracts with US defense contractors, familiar names such as Lockheed Martin, Raytheon Technologies, RTX, Boeing Defense, Northrop Grumman, and General Dynamics. This is a familiar pattern in U.S. military aid packages. Weapons are manufactured, assembled, and tested in the U.S., then transferred to Ukraine under the aid program. For example, the HIMARS High Mobility Rocket Artillery System manufactured by Lockheed Martin is considered a symbolic weapon in the war in Ukraine. Stinger and Patriot air defense missiles, Javelin anti-tank missiles, 155mm artillery shells are all included in the multi-billion-dollar orders that the Pentagon signed with U.S. corporations. Thousands of Stryker and Bradley armored vehicles were also ordered from General Dynamics and BAE Systems to aid Ukraine. So how have these corporations benefited? Since 2022, when the war began, the stock prices of U.S. defense giants have skyrocketed. Raytheon Technologies, RTX, has increased by more than 40%, from $100 to more than $140 in just 1 year. Lockheed Martin and Northrop Grumman have both recorded increases of 10% to 30%, depending on the time. Quarterly revenue set a new record, with backlog, that is the number of undelivered orders, amounting to tens of billions of dollars. For example, by the first quarter of 2025, Lockheed Martin reported $18 billion in revenue, up 4%. Raytheon Technologies reached a record of $80.7 billion in revenue for 2024, marking an increase of more than 17%. Northrop Grumman held $92.8 billion in backlogged orders, equivalent to more than 2 years of production. In other words, the war in Ukraine is not just a gunfight on the battlefield, it is also a golden springboard for the US defense industry, bringing a cash flow back to production lines in Texas, Virginia, or Alabama. That is the other front, silent, but the profits are louder than the gunfire. In other words, the war in Ukraine is not just a gunfight on the battlefield, it is also a golden springboard for the US defense industry, bringing a cash flow back to production lines in Texas, Virginia, or Alabama. That is the other front, silent, but the profits are louder than the gunfire. All this is done through two main support mechanisms. Presidential Drawdown Authority, PDA, allows the president to transfer weapons directly from the military stockpile. That is, the goods are already there, just sign the papers. And SHIP, Ukraine Security Assistance Initiative, USAI, allows new orders from US manufacturers, creating new contracts with huge value. To put it in perspective, a Tomahawk, a cruise missile manufactured by Raytheon, costs about $2 million. The HIMARS system, made by Lockheed Martin, is priced around $10 million. Each round of aid can include hundreds of weapon systems, with a total value reaching $1 to $2 billion per disbursement. In other words, every time a missile is launched, millions of budget dollars are pumped back into the US defense industry. While the United States continues to allocate substantial funding to its military, with a record $886 billion defense budget for fiscal year 2025, concerns are growing over how this emphasis impacts domestic priorities. This defense budget represents one of the largest peacetime military expenditures in US history. Yet, at the same time, many core social programs are facing challenges. According to the Kaiser Family Foundation, KFF, as of early 2024, more than 19 million Americans have been disenrolled from Medicaid as states resumed eligibility redeterminations following the COVID-19 pandemic. This situation has disproportionately impacted low-income families and children. Education funding continues to face stagnation or structural challenges in several states, despite rising costs and student population shifts. Meanwhile, key federal anti-poverty programs such as SNAP, food stamps, and HUD housing assistance have experienced flat or declining real dollar funding in recent years, even as inflation and housing costs have surged, according to Center on Budget and Policy Priorities 2023. These contrasts raise important questions, not necessarily about America's overall fiscal capacity, but about its budgetary priorities. As some analysts have noted, such decisions can be seen as favoring defense contractors and strategic interests abroad, rather than addressing the pressing needs of everyday Americans. During the May 2022 vote on the $40 billion aid package to Ukraine, Senator Josh Hawley objected, stating, "This is not in America's best interests. It ignores domestic priorities such as border security, allows Europe to avoid responsibility, undermines vital interests elsewhere, and lacks meaningful oversight." In a December 2023 interview, Senator J.D. Vance said, "I really don't care what happens to Ukraine. What concerns me is that the leading cause of death where I live is fentanyl coming across the southern border from Mexico." Several prominent Republicans, including Matt Gaetz and Marjorie Taylor Greene, have publicly opposed continued aid to Ukraine, arguing that America cannot keep sending funds abroad, while many Americans struggle with basic needs like food and healthcare. This division is reflected not only in political debates, but also in public opinion. Some, particularly in urban areas with large immigrant populations and Democratic voters, strongly support aid to Ukraine, viewing it as crucial to stopping Russian aggression and protecting global democracy. Conversely, many Americans in rural and former industrial regions, such as the Rust Belt where factories have shuttered, question why they face job losses, school closures, and hospital shutdowns, while their tax dollars fund a distant conflict. Why are we losing our jobs? Our kids are missing school, our local hospitals are closing, while our tax dollars are being sent to a country halfway around the world. And the concerns are no longer limited to Ukraine. June 21st, 2025, the United States launched a series of airstrikes against Iranian targets in response to drone attacks on US bases in Iraq. Although the government called it an act of legitimate self-defense, for many Americans it was just another example of how military spending continues to take priority while pressing civilian issues are pushed to the back burner. June 22nd, 2025 at Embarcadero Plaza, San Francisco. A protest of more than 300 people organized by the Answer Coalition. They are not right-wing populists nor extremists. They are workers, students, teachers, people asking, "What is my money going to?" The signs read, "Money for people's needs, not the war machine." We want healthcare, not harm. Not radical slogans, but voices demanding fair policies. Why is the health budget delayed when each round of military aid can cost $1 billion to $2 billion? Why are students still learning in classrooms with leaky roofs while HIMARS is packed up and shipped away? From small squares like San Francisco to tense hearings in Congress, one question is ringing not just in political circles, but in every middle-class household. As of now, the United States has allocated approximately $175 billion to Ukraine, a figure that is far from insignificant. Nearly 70% of this funding has gone to defense, weapons, military equipment, logistics, and training. The U.S. defense industry has surged, major contractors have reported record profits, stock values have soared, and tens of billions of dollars have flowed through military contracts. Ukraine has gained the strength and resources to sustain its war effort. But for many Americans, one question remains: what are we getting in return? In a country where over 40 million people rely on SNAP benefits to afford basic food, where millions of children attend underfunded and aging schools, and where many patients are forced to choose between medical treatment and paying rent, $175 billion isn't just a budget line. It is a political choice, one that reveals what the government chooses to prioritize: global strategy abroad or basic dignity at home. And in the end, if you're a taxpayer, you have every right, and perhaps even the duty, to ask, whose war is my money funding? And for what? If you have thoughts on all of this, let us know in the comments. And subscribe for more thoughtful analysis. Thanks for watching, and see you in the next video.
Waking up at 5 a.m. The first job of many young people in big cities in the US is driving Uber. At 11 a.m., they change into their uniforms, stand making coffee at Starbucks. At night, they continue their shifts at supermarkets, selling goods, packing orders until late at night. 3 to 4 jobs, every day, every week, no days off. Working until they are exhausted. They only have enough money to rent a house and eat casually. 2025, America, the world's #1 economy. And yet, a young generation is asking themselves, how many jobs do I need to survive in this country? Welcome back to Economy Roadshow. Today, we're taking a look at the multi-job crisis that's shaking up the American dream. How many jobs do I need to survive in America?
As according to the latest data from the U.S. Bureau of Labor Statistics in April 2025, nearly 8.4 million Americans are currently juggling 2 or more jobs just to make ends meet. Even more astonishing, on the TikTok platform, the hashtag 3jobworker, people who work 3 jobs, reached more than 100 million views in the first 3 months of 2025 alone. This is not just a trend, but a cry for help from the American working class, who are being pushed into a corner. The average rent across the United States has now surpassed $2,100 per month. A huge financial burden. Meanwhile, the federal minimum wage remains at $7.25 an hour, a number that has not changed for 16 years, since 2009. Let's do the math. Working 40 hours a week at that wage only brings in about $290 a week, or less than $1,200 a month, less than half the cost of rent. With that in mind, a single job only helps workers cover less than 60% of their basic expenses, forcing them to race against time and health to earn more. But the strange thing is that while Americans are struggling to make ends meet, the U.S. economy is not collapsing in the traditional sense. GDP growth is still positive, and the S&P 500 index, a gauge of the health of the stock market, continues to hit new highs in 2025. So why are workers still struggling? This is the economic dilemma that is brewing. The prosperity of financial markets does not reflect the reality of real income. According to recent figures, real incomes of workers after adjusting for inflation have not only not increased but have actually decreased compared to the previous decade, making them unable to keep up with the rising cost of living. This situation is not just dry numbers. On social media, thousands of viral videos with the theme "My Day," waking up at 5, working 3 jobs, still not enough to make ends meet, are spreading, reflecting the exhaustion of the young working class. With rents soaring and the minimum wage unchanged, many are forced to work hard but still cannot escape the spiral of debt. This is a warning bell. The US labor market is seriously imbalanced, and the American dream, where one job is enough to support a family, is gradually becoming a thing of the past. By 2025, America will be sliding into 2 classes: those who own assets, stocks, real estate, investments, will be on the rise. Those who have 3 jobs, but no home to call their own. According to Federal Reserve data, as of June 2025, total student loan debt in the United States had exceeded $1.7 trillion. More than 44 million Americans carry an average loan burden of $37,000 each. The pressure to repay this debt has forced many families to cut back on essential expenses, including food and healthcare. At the same time, the average annual cost of healthcare has climbed to $12,500 per person, according to the Centers for Medicare and Medicaid Services. For young workers earning limited incomes, this creates a vicious cycle, working full-time yet remaining trapped in debt. The financial stress has contributed to a 30% rise in depression rates among individuals aged 18 to 34, according to the National Institute of Mental Health. This discontent is spreading into a wave of protests. Protests calling for a minimum wage increase, currently at $7.25 an hour, have taken place in more than 150 cities in 2025, with demands for at least $15 an hour, according to the AFL-CIO. But government policy has focused on supporting big business, with a $500 billion stimulus package approved in March 2025 to prop up tech giants, rather than directly subsidizing workers. This has created a growing gap. While the richest 1% of the population owns 32% of the nation's total wealth, according to the Federal Reserve, the bottom 50% of workers control less than 2%. The cost of living in the US is becoming an unbearable burden. Over the past 2 years, food prices have increased by about 20%, according to data from the US Bureau of Labor Statistics. While gas prices in California have climbed to an average of $5 a gallon, the AAA reported in June 2025. Meanwhile, the federal minimum wage remains at $7.25 an hour, not rising with inflation, making workers' purchasing power plummeting. With such basic expenses, many families are sacrificing essential needs, from healthcare to children's education. At the same time, the gig economy, with jobs like Uber, Instacart, and DoorDash, offers flexibility but strips away basic benefits. According to the National Employment Law Project, more than 16 million Americans will work in gig jobs by 2025, but they are not considered full-time employees. This means no health insurance, no sick days, and no retirement funds. When risks from car accidents to illness come their way, they are left to fend for themselves, turning this freedom into an unforeseen financial burden. And then there's the American dream, the image of a comfortable life with a home and time off. That is slowly crumbling for millennials and Gen Z. According to Redfin, the median home price in major cities like San Francisco surpassed $1.2 million in mid-2025. By 2025, while the median wage for this age group is only about $45,000 a year, according to the US Census Bureau, the expectation of owning a home or having time off is now replaced by the harsh reality of getting by week without being crushed by debt. More than 70% of young people under 35 feel the American dream is impossible, according to a Pew Research Center survey in May 2025. This is not just a personal story, but a warning about a deeply divided society. With prices rising, gig work lacking protections, and the American dream fading, American workers face an uncertain future. The mental health and well-being of young people are at an alarming level. According to the latest McKinsey 2025 report, 46% of Gen Z and millennials admit to severe burnout, a state of physical and mental exhaustion due to work pressure and living costs. In particular, among gig workers such as Uber drivers or DoorDash delivery workers, depression rates are up 35%, according to data from the National Institute of Mental Health. These numbers are not just statistics, but a warning about a generation that is deeply hurt by harsh economic realities. At the same time, trust in the system is collapsing. According to the Edelman Trust Barometer 2025 survey, more than 62% of young Americans have lost faith in education, where they believe degrees no longer guarantee good jobs, as well as in elections and traditional finance such as banks or pension funds. This frustration has spilled over into new social movements: soft quitting, doing the minimum to keep a job; quiet quitting, refusing to work overtime; and anti-work, movement against a culture of overwork. These movements culminated in thousands of posts on Reddit and TikTok in June 2025, calling on the younger generation to quit the rat race. A clear sign of deep dissatisfaction, these movements are not just individual protests, but also reflect a changing society. With more than 80% of Gen Zers in favor of remote work or reduced hours, according to a May 2025 Gallup poll, young people are looking to redefine success, no longer about homeownership or a 9 to 5 p.m. job, but about work-life balance and mental health. However, this poses challenges for businesses and governments as the core workforce begins to turn away from the traditional model. In developed countries like the UK and South Korea, the trend of working multiple jobs at the same time is growing rapidly. According to the Office for National Statistics, more than 2.1 million Britons will have a second job by 2025, up 15% from 2023. While in South Korea, Statistics Korea recorded 1.8 million. Young people working part-time to cover living expenses, up 12% over the same period. Pressure from high housing costs, an average of £1,500 a month in London and £800,000 a month in Seoul. And the cost of education and healthcare are forcing workers to race against time, similar to the model seen in the US. But the problem doesn't stop there. Low-wage service economies, like the Philippines and Indonesia, are rapidly adopting the gig model, from Grab drivers to Lala Move delivery people, without adequate social protection. According to the International Labor Organization, ILO, in 2025, more than 5.2 million in Indonesia will participate in the gig economy, but only 10% will have access to health insurance or pension funds. This creates a vulnerable class of workers who work long hours, sometimes 12 to 14 hours a day, but still cannot escape poverty, with average incomes of just $200 to $300 a month in urban areas. This spread raises a big question. Is the current global economic model, with its reliance on gig jobs and lack of supportive policies, creating a generation of invisible workers? The OECD warns that without reform, the share of workers without social protection could rise to 40% globally by 2030. From the US, UK, South Korea, to the Philippines and Indonesia, the story is the same. The cost of living has skyrocketed, while labor protections have failed to keep up, leaving millions of people in unprecedented precarious situations. There's a saying going viral on social media: the system isn't broken, it was built this way. This reflects not just an income crisis, but the collapse of a model of life that was once considered a symbol of America. From having to work 2 or 3 jobs to make ends meet, to the pressure of debt and lack of benefits in the gig economy, Young people are trading their health, time, and dignity just to survive. The American dream used to be about houses, cars, and family vacations, an ideal that baby boomers achieved with a stable job. But for millennials and Gen Z, that dream is far away. According to the US Census Bureau, only 38% of young people under 35 will own a home by 2025, down 12% from a decade ago, while the average cost of buying a home in major cities exceeds $400,000. Instead, the concept of living well is now redefined. Avoiding overtime, finding small happiness in quiet quitting, or even giving up personal ambition altogether. This is a clear sign of a social model that no longer meets the expectations of a new generation. That is the reality that Americans, especially the younger generation, are facing. For foreigners, America was once a dream destination, a place where a plane ticket meant a chance to change your life. But now foreigners are starting to wonder, is America still worth living in? According to a 2024 Gallup survey, the percentage of immigrants in the US who feel satisfied with their current life has dropped to 54%. The lowest level in a decade. Nearly 38% of immigrants said they felt exhausted by the cost of living, job insecurity, and stress. And notably, 26% of young immigrants under 35 said they were considering leaving the US in the next 5 years, mainly for financial and quality of life reasons. The American dream for many low-income immigrants is no longer a light at the end of the tunnel. It is a shadow behind closed doors. America is still an economic powerhouse, but for them, it is a game where you always start from the bottom. In a globalized economy that forces workers to sacrifice more than ever, can we rebuild a new dream? One where health and dignity come first? That's a wrap for today. Thank you for watching. Leave your comments and subscribe to the channel for more interesting analysis videos. A decision on the desk of Iran's parliament, but its reverberations could ripple through Wall Street, the Kremlin, Beijing, and into the wallets off every household. The Strait of Hormuz, a geopolitical choke point less than 40 kilometers wide, holds the lifeblood of nearly 20% of the world's oil supply. On June 22nd, 2025, Iran's parliament gave the green light to completely block the waterway in response to US airstrikes on nuclear facilities. The final decision will be made by Iran's Supreme National Security Council. If the Hormuz door is indeed closed, it would be more than just an energy shock. It would be a blow to the world's economic lifeline. Oil prices could not only surpass $150 a barrel, but also spark a global chain reaction from inflation, debt crises, to a reshaping of the balance of power between the US and China and Russia. Welcome back to Economy Roadshow, and without further ado, let's dive in and find the answers to the questions we've just posed. Before we get to the economic damage, let's understand the importance of the Strait of Hormuz. This is no ordinary sea lane. The Strait of Hormuz is one of the most critical choke points for global energy transit. Any disruption in this area could severely impact the global economy. Why? The Strait of Hormuz, located between Iran and Oman, is only 33 kilometers wide at its narrowest point. But every day, 18 million barrels of oil, equivalent to 30% of global oil trade, pass through it. This is not just a number, it is the blood flowing through the world's economic arteries. Countries such as Saudi Arabia, the UAE, Iraq, Kuwait, almost the entire Gulf region depend on Hormuz to pump oil into the world. In addition, 30% of the world's liquefied natural gas, LNG, mainly from Qatar, also passes through this route. Iran has coastal missiles that can fire hundreds of kilometers covering the strait. Their fast patrol boats can close in on oil tankers in minutes. And mines, just a few dozen, are enough to turn Hormuz into a deadly minefield. Recall the incident that happened in June 2019. 2 oil tankers, one Japanese, one Norwegian, were attacked near Hormuz. The US and its allies accused Iran of being behind it. The result? Brent oil prices at that time jumped 15% in 2 days from $60 to nearly $70 per barrel. This time, if Iran blocks the entire strait, not just a few ships, the whole world will face a major energy crisis. However, another bitter paradox is that energy is also the lifeblood of Iran. If this strait is closed, the Iranian leadership will suffer more pain than what they are suffering from the attacks. Iran exports 1.5 to 2 million barrels of oil per day through this strait, mainly to China. This is the main source of money that keeps Iran's economy from collapsing under US sanctions. If it really closes Hormuz, it would hurt itself first. So why do they still threaten to close the Strait of Hormuz? Once the Strait of Hormuz is blocked, Iran will not only upset the global geopolitical balance, but the world economy will also face a major shock when major economies such as the US, China, and the European Union may suffer heavy losses. Historical facts have proven that Hormuz is a red line. In 1988, Iran laid mines in the strait, and an American ship was hit by a mine, and the US responded by destroying half of Iran's navy in just 24 hours. Further, in 1973, OPEC embargoed oil because of US support for Israel. Oil prices quadrupled from $3 to $12 per barrel, pushing the world into recession, inflation 10%. If Iran blockades Hormuz, how long will the world hold out? And who will pay the highest price? Let's uncover the horrifying figure. As of now, the Iranian parliament has given the green light to completely block this sea route in response to the US airstrikes on the Natanz nuclear facility, waiting for the Supreme National Security Council to nod. The world will face an unprecedented economic storm. Oil prices will skyrocket, financial markets will shake. Inflation will return like the nightmare of 2022. No one can escape this vortex from the US, EU, China. Brace yourselves, because these are the scenarios that could happen. We have 3 scenarios if Iran blocks Hormuz, from mild to catastrophic, each of which could change the global economic game. Scenario 1. Iran shuts down completely, creating an energy storm. If Iran blocks Hormuz, 18 million barrels of oil per day, 20% of the world's supply, will immediately disappear. According to Goldman Sachs, Brent oil prices will jump to $120 to $150 per barrel in 48 hours. The worst-case scenario? $250 per barrel if the shutdown lasts longer than 2 weeks, as predicted by Rapidan Energy. Gas prices will double, pushing living costs skyrocketing. Europe, which is dependent on Qatari LNG, will face a cold winter. German and French factories will have to cut production. Cuts. Risks? Global recession. World GDP falls 2-3%, like the 1973 oil crisis. Scenario 2, partial disruption. A bleeding wound. Iran may not close the pipeline completely, but instead use mines, missiles, or patrol boats to harass, as in June 2019 when 2 Japanese and Norwegian oil tankers were attacked. Oil prices then rose 15%. From $60 to $70 per barrel. If repeated, oil prices could reach $90 to $120 per barrel within a week. Consequences: logistics costs increase by 20%, stock markets will be shaken. The S&P 500 fell 1.1% just on the threat and could now lose 5-7% if the disruption continues. Gold, currently $3,426 per ounce, will jump to $4,000. Inflation re-emerges like in 2022 when the US CPI hits 9%. Scenario 3. Prolonged threat. Psychological warfare. Iran may only threaten, not act as many times before, but just a rumor, the market panics. On June 22nd, 2025, when the Iranian parliament passed the resolution, oil prices increased by 5% in 24 hours, according to Reuters. If the threat persists, oil prices may fluctuate between $85 to $100 per barrel. Investor sentiment is uncertain, energy stocks increase, but other sectors such as technology and consumer goods plummet. The US dollar strengthens, making it difficult for many countries, when importing US goods is 10 to 15% more expensive. Long-term consequences: persistent inflation, central banks raise interest rates, halting the recovery after COVID. No matter what scenario happens, no one can escape the spiral. Gasoline, electricity, and food prices skyrocket. The supply chain, fragile after the Suez Canal incident 2021, will be jammed again. The risk of a global recession is more evident than ever, especially when the world economy is struggling with the Ukraine war and US tariff policy. Technically, Iran could completely blockade Hormuz. It has hundreds of YJ-12 anti-ship missiles with a range of 400 kilometers covering the strait. Revolutionary Guard fast patrol boats can close in on tankers in a moment. Iran exports 1.5 to 2 million barrels of oil per day through Hormuz, accounting for 70% of its export revenue, equivalent to $50 billion per year, according to EIA 2024 data. Most of it goes to China, its largest customer, keeping Iran's economy from collapsing under US sanctions. If it closes Hormuz, Iran would cut off this flow of money. The result? Domestic inflation, already 30% in 2024, could soar to 50%. Iranians would line up longer to buy bread, gasoline, and basic goods. What's more, closing Hormuz would be a stab in the back of Iran's last ally, China. Beijing imports 10.8 million barrels of oil per day, 15% from Iran. If Hormuz is blocked, Chinese factories will stop operating and commodity prices will increase by 20–30%. Will China sit still? No way. They will turn their back, seek oil from Russia, Brazil, or even reduce purchases of Iranian oil. Iran will lose its source of income and be completely isolated. Remember 2012? When the US tightened sanctions, Iran's oil exports fell by 50% and its GDP lost 7%. This time, the consequences will be worse. And don't forget the US. Closing Hormuz is a declaration of war on the Fifth Fleet in Bahrain. In 1988, Iran laid mines, and the US destroyed half of Iran's navy in 24 hours. This time, the US may not stop at ships, but go straight to Iran's oil facilities. Iran knows. Closing Hormuz is digging its own grave. Iran may threaten, but closing Hormuz is a risky gamble. Cutting off its own source of income, putting China in a difficult position, and angering the US, Iran will face economic and military isolation. But if they take the risk, who will be the biggest victim? China will be the most affected. It is the world's largest oil importer, with an output of more than 10 million barrels per day, of which nearly 50% comes from the Gulf, passing right through Hormuz, leads to three immediate consequences. Rising oil prices, production costs in China increase sharply, from petrochemicals, plastics, logistics, transportation, all are under pressure. The global supply chain is clogged in China. When input costs increase, the cost of exported products also increases. This not only stifles domestic growth, but also damages China's partners. Finally, China is pushed deeper into dependence on Russia. In the context of escalating market oil prices, Beijing is forced to increase oil imports from Russia despite Western sanctions and accept the geopolitical risks that come with it. India, Japan, South Korea are also in the game. These economies do not have significant domestic oil reserves and are completely dependent on imports, mainly from the Middle East. If Hormuz is closed, they will face a double crisis: supply shortages, skyrocketing prices. India, where petroleum accounts for 40% of the Consumer Price Index, CPI, could see inflation exceed 6 to 7%, forcing the central bank to stop monetary easing, leading to the risk of growth stagnation. Japan will have to spend tens of billions of dollars more to import oil and liquefied natural gas. South Korea, which is almost entirely dependent on imported energy, will suffer a shock to production costs, especially in the petrochemical, automotive, and electronics industries. Meanwhile, Russia can take advantage of the opportunity to increase its influence both geopolitically and economically. If Iran really closes the Strait of Hormuz, the US will certainly not stand idly by. With its superpower status and direct interests related to oil and global energy security, the US response is predicted to be divided into 3 layers. Layer 1, tactical military intervention, deploying the Fifth Fleet in the Persian Gulf, coordinating with Gulf allies to create a safe maritime corridor for international oil tankers. A familiar scenario like the Iran-Iraq war in the 1980s could repeat itself, when the US armedly escorted oil tankers to ensure the flow of energy. Layer 2, financial sanctions, further isolating Iran. The US could expand the sanctions to Iran's banking sector, ports, and energy transit systems, causing Tehran to fall into a state of economic suffocation, provide additional support to Saudi Arabia, Israel, and the UAE with weapons and intelligence if tensions escalate into a regional military conflict. Layer 3, seize the economic opportunity, boost shale oil exports to Asia, benefiting from high prices and supply disruptions from the Middle East. At the same time, the crisis has caused international investors to flee to USD and US Treasury bonds, increasing the flow of money back to the US, helping Washington consolidate its role as a global financial center. However, make no mistake, the US does not want Hormuz to be closed. It only reacts when it is forced to react, because the cost of controlling chaos is always higher than the benefit of expensive oil. Iran's threat to close the Strait of Hormuz is considered a huge psychological boost for the global market. Even before it is implemented, the fear has created widespread fluctuations in oil prices, finance, politics. This is a double-edged weapon which can cause serious damage to Iran itself if not carefully calculated. In today's globalized world, any choke point in energy has the power to spread to every economy, from superpowers to developing countries. Historical scenarios show that quick action is needed to avoid escalation. Can the global economy withstand it? Only if all parties exercise restraint and find a diplomatic solution can we avoid this economic storm. Thank you for watching. Please leave your comments and subscribe for more interesting analysis videos.